Good morning, everyone. Coming to you from Houston, Texas this morning. We have a special guest today. I have George Goncalves with us today from MUFG. He is the head of U.S. MicroStrategy. George, really great to have you here, and thanks. We really appreciate it.
Great to be here.
And of course, I always have my partner, CFA, head of rates, all things Fed and liquidity, Greg Faranello. Hey, Greg, how are you, sir?
Michael, good to see you again.
All right, Greg. So I'm on the road here, so I'm going to let you and George have at it.
Sure. Well, it's good to be back. We've been doing this now for a couple of years, George, and we're really excited to have you here today to talk about the Fed. It's obviously Fed week. What are your thoughts heading into the week?
Look, it's a critical week, especially given how much markets have moved, and especially in the rate space, and also what's going on in the money market. So there's plenty to talk about, and I'm sure the Fed's going to have their hands full trying to figure out, what this all means. But at the end of the day, really, this is in our view, at least the start of the proper taper discussion. And so this meeting will kick off that, and will probably be the point where they'll start to signal going forward what their plans are. I mean, at this specific meeting, I'm generally along the lines of consensus, which I don't think they want to give out specific details. I mean, there's always the risk that during the press conference we'll get something from Chair Powell from a question from a reporter. But in general, I think it's going to be all about we've had we're on this track, and it's going to line up for something happening towards the second half of this year as we kind of go through the year. And I think beyond the tapering, which is really what everyone's really focused on, considering it's all about liquidity. I think the issues around liquidity. I think that maybe something on inflation where the risk could be that there might be a token gesture that, look, maybe it's not as transitory as they thought about it initially, which then also aligns with their tapering plans, because the only way to stop this inflation from getting out of hand would be to start to dial back all this easy money. So I think that those are some of the risks that are out there, as well as any other questions that you may get.
That sounds about right. It seems like transitory, we've been talking about transitory now for the better part of 2021. Certainly it seems like that word has become a little bit of taboo. Certainly when you look down in Washington, when you look at the timetable here, you look at Jackson Hole in August. September has been a pretty big month for the Fed in general. Last year we had the framework changes, and then in September the Fed linked their changes to interest rate policy. What's your view 3 to 6 months out? What's the more beyond this week's meeting? What's your view a little bit longer term? Call it 3 to 6 months.
So assuming this is the meeting that kicks things off, and I think it is, then, as you say, rightly so, it's going to be Jackson Hole, and any sort of papers that discuss around like the limitations of or the need for changes around central bank policy and how they conduct policy, especially through the banking system, and how there might be issues with just too much liquidity and how it's causing issues on RRP, which we'll discuss in a moment, or leading to usage of RRP. And so I think that the next natural step is September, and you're absolutely right. That September has been meetings where they wanted to taper in 2013, I think, in my opinion, back then, but they actually postponed it to December because of market volatility, which is another problem to think about, because markets are all pretty much fully valued across many metrics that I look at least on credit and equities, and even long duration assets and fixed income are really rich on a relative basis. And so if September, October creates some sort of volatility, does the Fed kind of blink here and then push it back to December? That's always the risk. But looking forward over the next 3-6 months, they set the timetable sometime in September, I think, as long as everything goes well. And that again is predicated on the financial markets staying stable and jobs numbers continue to come in well. And although that we're going to be coming off peak activity in the economy, we're still growing at a pretty healthy clip. And so they have to spin a positive message and not get too lost in the weeds. And and as September comes along, there's a possibility of September or a November announcement of the tapering, and then commencing thereafter. Meanwhile, we have the debt ceiling also will be happening during this time period, or the issues around the debt ceiling as we're getting closer to the end of the month and the deadline from years past. That also could then lead to excess liquidity going into RRP and really kind of mucking up the plumbing along the way. So this is really going to be a challenge for the Fed on two fronts, both the term premium compression that's happened in the markets, as well as too much liquidity from all different corners of the government, really. So I think that's going to be what their challenge is. But they have the tool, they have to taper, they have to get this up and running, and they have a number of key events that can communicate those messages.
Yeah, certainly. Thank you for that. I mean, certainly keeping the dialogue moving forward, risk manage, if you will, prudence, some of the words they used in the minutes. I sit and I wonder about risk factors, right? Either way, because, I can see scenarios where the Fed could turn a little bit more hawkish, and at the same time, perhaps they could shift the other way. I mean, you look at what Treasury yields are doing, you look at the global landscape. I mean, you and I know Treasuries are the global benchmark, right? So I think rates are telling us something globally in terms of the pandemic, the uneven nature of that. What do you see at upside and downside risks in terms of Fed policy going forward?
So, I mean, I guess on the upside risks, it depends on how the rest of the world handles this next variant, the evolving of Delta variant, and does everyone rush back into outside of the U.S. more so, I think, into more of a lockdown mentality again, and that really hurts global growth. I think the Delta variant, unless it becomes much worse in the U.S., I think is more of a global phenomenon than it is a U.S. phenomenon. But it's the pandemic is not clearly over yet, and so that's still factoring into the thought process. I don't think it's going to change the Fed's thinking in the near term. I think the Fed's going to focus on domestic issues more so now, considering that the markets are pretty well flush with liquidity. But on the so if there was less of a lockdown, that would be better global growth. If central banks don't rush to tighten, that would also continue this recovery longer. The issue, though, on the flip side of basically the other side of the argument is this a sustainable period in time of growth? Are we going to have sustainable growth and without fiscal support, without central bank easing? So that's a big risk, and trying to modulate that is what they're going to do after really flooding it more, in my opinion, than what they should have done over the course of the last year. The other issue is they're basically hostage to financial conditions, and so if stock markets go down, are they going to blink? Are they going to just see through and say, no, the right thing to do is we have to dial back on all this excess liquidity? And then I guess the really bigger overarching question of all this is that central banks around the world, not just the Fed, have helped to finance their local governments. And so is there a risk of fiscal dominance really setting in that then requires central banks to actually help, not directly or indirectly underwrite the debt? And that's a much bigger philosophical question. I think that the pandemic, gave cloud cover for that for now. But going forward, it's not as if entitlements are going to get any better or issues around the debt are going to get any better. So that's a bigger issue, longer term. And if they were to force to come back and do QE on a perpetual basis, that's the biggest risk of all.
Yeah, no, for sure. In our weekly this week, we wrote back about 2018, right, George, where we saw financial conditions. They tried to reduce the balance sheet. They were trying to raise interest rates. We saw what financial conditions did back then. And the question is, are they going to be able to come out of this period that we're in right now? So those points are fantastic. I think they're spot on. From George and I here, Mike, I think that's about it.
Greg, if you could just give the thoughts on the 10-year and the yield, that'd be great.
Sure. I think the peak in 10-year yields in and around 175, those themes now have abated over the last, we call it second quarter. Certainly, if you look on the Treasury side, I mean, to George's point, I mean, the Treasury's general account with the debt ceiling, they are trying to roll out that money. So issuance has certainly come down. There has certainly been demand from real money accounts. But I also think, too, on a global basis, you look at Treasury yields, you look at what's gone on right now, the uneven nature of the recovery, there's been just strong demand.
It makes perfect sense. Listen, Greg, you know how much I love doing this, and thank you to George, a fantastic guest, and very meaningful to us. So our deepest appreciation for you, George, taking the time this morning. Greg, look forward to doing this again next month. We wish everyone continued safety. Have a great day, everyone.